The stocks are coming off their steepest drop in 2 weeks on concern about the, slowdown in the housing market, consumer confidence, also possibly crimping spending. Our next guest says this is just the beginning. We're joined by Bill Spiropoulos, President and CEO of CoreStates Capital Advisors. Comes to us from Philadelphia this morning. Thanks for coming on, Bill. Appreciate you getting up early and giving us your insight here today. What is it about this marketplace that scares you most?
Well, it's a deja vu. You know, it reminds me a lot of 1987, unfortunately. 1987 was the year that Iran dominated the headlines and oil was the talk, and a man wasn't a man unless he owned 40% oil in his portfolio. And then for our added pleasure, we had the real estate downturn, which was promulgated by the change in tax law, TEFRA. And that ushered in a bear market where we saw real estate prices fall 50% over the following 5 years. So, you know, there's a lot of similarities that I find very disturbing. And then, of course, everybody's singing the Happy Boy song on Wall Street, and margin debt is at record levels, and everybody's forgot about risk, and there's a little too much complacency, if you ask me.
I just want to jump in and give you some headlines, folks. The UK Ministry of Defense has announced that their GPS data shows that those sailors were 1.7 miles within, nautical miles within the Iraqi, not Iranian, Iraqi water space, if you will. Bill, back to business if we can here. If you look at some of the notes or some of the comments in here today, you're worried about the 12,000 level in the Dow. That's about 400 points below where we are right now. Why is that such a key level for you?
Well, you know, the market's made a break in February, and we had a very rapid 6% decline. The 12,000 level basically held, and a lot of people are convinced that that was the correction. I think if we test 12,000, we will take it out, and that'll change the mindset to where complacency is out and risk management's back in. And unfortunately, I think that this correction probably is going to be a double-digit one, and will end that longest period in Wall Street modern history of advance of, you know, over 100% without a 10% correction.
So, I mean, when this one started, just had all the look and all the feel that this was going to be the big one, as they say, but it kind of petered out, and now it seems but a, well, not distant memory, but not that long ago. What's it going to occur like? I mean, how do you get ready for something like this if you're convinced that it's going to happen?
You know, I think as a matter of practice, what the average investor has to do today, it's very important to move from a 4-cylinder engine to an 8-cylinder engine. And for the last 25 years, your 4-cylinder engine, which was stocks, bonds, cash, and real estate, worked fabulous. Going forward, if we're going to have a replay of some of the tough themes that we faced in the 70s with energy and inflation and weak currency and rising commodity prices and inflation, you have to introduce another 4 cylinders, and that is energy, currencies, managed futures, raw materials. And there are lots of facilities available for the average investor to participate there. And what's important is you get a very low correlation compared to the other categories, so that if you do have a material downturn, whether it's a recession or a just stagflation, a word we haven't heard in a long time, is very probable.
And if we don't, huge underperformance relative to the standard old V4?
The blend between the 8 will work just fine. And if you think that there's a question of that, look at what Harvard and Yale endowment funds have done. They have, both of them have 50% of their multi-billion-dollar endowment fund in these other 4-cylinder types of investment categories.
Let's talk about oil, because one of the great economic or equity anomalies was the fact that the market did not collapse in the face of record oil. I mean, we got to 78 last July, but even, you know, whether you're high, low, or whatever, we're at record levels for oil, and it still hasn't crushed the consumer or the economy. Is it going to be different this time?
When you see the oil complex where demand and production globally is matched off, somebody in the world has to stop growing. I hope it's not us, but I don't see any way that we can avoid significantly higher oil prices over the next 4, 5, and 6 years. And that's going to have an impact on inflation, on pricing, on a number of things.
All right. Bill Spiropoulos, thanks for coming on. Appreciate it. President and CEO of CoreStates Capital Advisors. Folks, a little bit of a break here, but first, Matt Miller, tell us what he's working on over at the stocks desk.